Imagine you are standing in front of a familiar ATM on a quiet corner in your neighborhood. It is a crisp morning in 2026, and you feel a sense of accomplishment because you have worked hard for decades to build your nest egg. You slide your card into the machine and type in your PIN. You decide to withdraw $100 in cash. The machine whirs, and then it hands you a crisp $100 bill. Having cash in your hand always feels good because it feels like a tangible reward for your discipline. But just as you are putting that money into your wallet, a bank official walks up to you with a clipboard. He looks you in the eye and says that since you just took $100 out, the value of your home has just dropped by exactly $100. And he tells you that the Internal Revenue Service is standing right behind that machine, and they are going to take $15 out of that $100 you just withdrew. You would probably think that is the most ridiculous bank in the world. You would realize that you did not actually get any richer. You simply moved money from one pocket to another and lost a portion of it to taxes in the process. But here is the cold, hard truth that most retirees in 2026 still do not want to hear. This is exactly what is happening to your investment portfolio every single time a company pays you a dividend. Welcome to the largest psychological illusion in the history of modern finance. The dream of passive income through dividends has been sold to us as the ultimate safety net for retirement. We have been told that dividends are like interest from a bank account or rent from a tenant. We have been told that as long as we do not sell our shares, we are not touching our principal. But this narrative is the single most expensive error you can make with your money. Today, we are going to strip away the emotions and look at the raw mechanics of how money actually works. I am going to show you why chasing dividends is making you poorer over the long run. And more importantly, I am going to show you how to take back total control of your wealth. Let us start by looking at what actually happens on the day a dividend is paid. Most people believe that a dividend is a gift from a company to its loyal shareholders. They think the company is giving them a little something extra on top of the stock price. But a stock is not a magical bond that pays interest. A stock is partial ownership of a business. Imagine you own a small lemonade stand, and there is exactly $1,000 in the cash register. Since you own 100% of the stand, your business is worth $1,000. If you decide to pay yourself a dividend of $100, you take that money out of the register and put it in your pocket. Do you have more money now than you did a minute ago? Of course not. You have $100 in your hand, but your business is now worth only $900. Your total net worth has not changed by a single penny. This is exactly what happens in the stock market every single day. On the day a dividend is paid, the stock exchange automatically marks down the price of the stock by the exact amount of the dividend. If a stock is trading at $100 and it pays a $2 dividend, it will open the next morning at $98. The market is efficient, and it knows the company is now $2 per share poorer than it was yesterday. You did not get richer. The company just liquidated a part of its value and handed it to you. It is the financial equivalent of withdrawing cash from an ATM. So why do so many people celebrate when they see a dividend hit their account? It is because our brains are hardwired to separate capital from income. This is a mental accounting bias that dates back to an era when selling stocks was difficult and expensive. We view the stock price as the golden goose and the dividend as the golden egg. We are terrified of selling a share because it feels like killing the goose. But in 2026, we live in a world of zero commission trading and fractional shares. There is zero mathematical difference between receiving a 4% dividend and selling 4% of your shares. In both scenarios, your remaining investment value is reduced by 4%. The only difference is that with a dividend, you have zero control over the timing. And that brings us to the biggest hidden drain on your wealth, which is the Internal Revenue Service. When a company pays you a dividend, they are forcing you to take a taxable distribution. It does not matter if you need the money this month or not. It does not matter if the market is at an all-time high or in a deep slump. The company decides when you get paid, and the government decides when you pay taxes. If you are in a taxable brokerage account, you owe taxes on that money immediately. Even if you have the dividends set to automatically reinvest, you still owe the tax. This creates what we call a tax drag on your portfolio. Imagine if you could have kept that tax money inside your account to compound for the next 20 years. The difference in your final balance could be hundreds of thousands of dollars. By chasing high-yield stocks, you are essentially volunteering to pay the government sooner than you have to. And for a retiree like you, every dollar of tax efficiency matters. But the problem goes even deeper than just taxes. A company's decision to pay a large dividend is often a sign of something much darker. It is often an admission that the management has run out of good ideas. Think about a company like Apple or Microsoft when they were in their massive growth phase. They paid zero dividends for years. Why? Because the management believed they could generate a high return by reinvesting that cash into new products and expansion. They believed that $1 kept inside the company would be worth $5 in the future. When a company starts paying out a massive portion of its earnings, it is telling you that they do not see any better use for the money. They do not see any new factories to build or new technologies to develop that will give a good return. So they just give the money back to you. While mature companies can be stable, chasing the highest yields often leads you into value traps. These are dying companies in shrinking industries like tobacco or legacy telecommunications. They pay high dividends because they are slowly liquidating themselves. You are essentially buying a melting ice cube because you like the puddles of water it leaves behind. If you want to build real wealth in retirement, you must focus on total return. Total return is the combination of price appreciation plus any dividends. It is the only metric that actually matters for your future. If stock A pays a 10% dividend, but the share price drops 5% every year, your total return is only 5%. If stock B pays zero dividends, but the price grows 10% every year, stock B is the clear winner. You cannot pay your bills with yield alone. You pay your bills with equity. This leads us to the most powerful strategy for a modern retiree, which is called homemade dividends. Homemade dividends give you the power that the big institutions do not want you to have. Instead of waiting for a company to send you a check, you decide when you need cash. If you need $5,000 for a trip to Europe, you sell $5,000 worth of your best performing stocks. By doing this, you are in total control of your tax bill. You can choose to sell shares that have the highest cost basis to minimize your capital gains tax. You can wait until a year when your other income is lower to sell, so you stay in a lower tax bracket. You can even use a strategy called tax loss harvesting to offset your gains and pay zero taxes at all. This flexibility is a massive mathematical advantage that dividend investors surrender voluntarily. You are no longer a victim of a corporate board's decision. You are the CEO of your own life. I know that selling shares feels scary to many of you. It feels like you are shrinking your pie. But remember that if you own 10% of a company that is growing rapidly, your smaller slice of a much larger pie is worth far more. Would you rather own 100 shares of a company that is stagnant or 90 shares of a company that is doubling in value? The math is clear, but the psychology is hard. We have been conditioned to believe that a steady paycheck is the only way to be safe. But in the volatile world of 2026, true safety comes from diversification and flexibility. If you restrict yourself only to companies that pay dividends, you are ignoring huge sectors of the economy. You are missing out on the innovators and the disruptors who are shaping the future. A globally diversified portfolio of the best companies in the world is your best defense against inflation. It is your best defense against a weak dollar. And it is your best path to a retirement where you never have to worry about money again. Think about the most successful investor of our time, which is Warren Buffett. Buffett loves to receive dividends from the companies he buys like Coca-Cola. But look at his own company, Berkshire Hathaway. Berkshire Hathaway is one of the most cash-rich companies in history, and it has never paid a single dividend. Why? Because Buffett understands the math of compounding. He knows that if he pays a dividend, his shareholders will be taxed, and that money will leave the engine. He believes he can allocate that capital better than any individual shareholder can. If you trust the genius of Warren Buffett, you should pay attention to what he does with his own money. He retains earnings to create more value for everyone. So how do you break the dividend trap? You have to change your perspective. Stop looking at your brokerage account for a yield percentage. Start looking at the bottom line of your total net worth. Understand that a dividend is just a forced partial sale of your business. If you need cash flow, build a system where you sell a small portion of your portfolio every quarter. Set it up to be automatic if that makes you feel more comfortable, but keep the control in your hands. This allows you to stay invested in high-growth areas while still getting the cash you need. It aligns your strategy with the math of wealth creation rather than the psychology of fear. The world of finance is full of myths that are designed to make you feel safe while they slowly drain your potential. The free money illusion is one of the most persistent of those myths. But now you know the truth. You know that there is no such thing as a free lunch in the stock market. You know that taxes and inflation are the real enemies of your retirement. And you know that total return is the only path to lasting freedom. I want you to take a long look at your portfolio today. Are you holding on to dying companies just for a 4% check? Are you paying more in taxes than you need to because you are afraid to sell a few shares? It is time to stop eating the crumbs and start growing the whole pot. 2026 is a year for bold moves and clear thinking. You have worked too hard for too long to let a psychological bias hold you back. Take the steering wheel of your financial life. Build a portfolio based on math and logic. If this conversation challenged the way you think about your money, then I have done my job today. Knowledge is only power if you act on it. If you found value in this breakdown and you want more strategies to protect your wealth in this changing world, please consider showing your support. Click the like button if you are ready to stop chasing yield and start chasing freedom. And if you want to be part of a community that values the truth over comfortable myths, make sure you are following along for our next update. Leave a comment below with the words, "I am in control," so I know you are ready to lead your own financial future. I will be right here to help you navigate every step of the way. Thank you for your time and for your commitment to your own success. I will see you in the next one.